China's real economy was hit hard in the 3 months of June as a result of authorities' COVID-0 restrictions. From 4.8% at March, annual real GDP growth dropped to just 0.4% in June. Of note though, nominal GDP growth held up better. Year-to-date nominal growth printing in June around 6.5% compared to 2.5% in real terms. This is despite consumer inflation remaining low and producer price inflation having halved since its late 2021 peak. Looking at the detail of the GDP report and available partial data, it is also important to recognise that the shock from COVID-0 looks to have been contained within the June quarter. Industrial production rebounded through May and June after April's shock to effectively catch up by end June. And, despite all the headlines of shut ports and logistics snarls, the trade balance surged to fresh highs in June. Even household consumption looks to have momentum. Annual growth in retail sales bouncing from minus 11% at April to plus 3% in June, as the service PMI rose back to its highest level since mid-2021. Witnessing to the geographical dispersion of investment outside Tier 1 cities, and hence the more limited impact of COVID-0 policies on the sector, year-to-date growth in fixed asset investment held above 6% throughout the June quarter, even as growth in real estate investment fell to a new cycle low of minus 5% under the weight of regulatory reform. While authorities' 5.5% GDP growth target now looks to be well and truly out of reach on a year average basis, it can still be achieved for annual growth to December. To do so, annualised growth circa 14% is necessary through the second half of this year. This might seem impossible, but it is actually very close to the gain seen in the 6 months to December 2020 after the initial near 56% annualised rebound in the 3 months of June of that year. Not only then is there historical precedent for a strong rebound, but, as discussed, momentum looks to be with China's economy, and further policy support is coming. Year-to-date aggregate financing to the economy is up 18% on 2021, led by funding for local government infrastructure. The policy stance towards private households and businesses is also progressively being eased, and there's talk of the central government bringing forward additional funding for local governments to supercharge the recovery. In terms of the risks to the outlook, there are two worthy of careful scrutiny. First, clearly there is a risk of another temporary shock from authorities' COVID-0 policy. Although to be meaningful, a new outbreak would have to be sizable and situated in a major city or production region. Second, the past few weeks have seen reports of purchases of yet-to-be-completed apartments cease payments on their mortgages, raising the risk of a cash squeeze for some developers. As it stands, this situation is limited to projects being completed by builders with questionable financials, and so it is likely to have only a marginal effect on aggregate activity. But, if it spreads, it could shock already weak construction activity lower still, creating additional pressure on stretched local governments whose finances depend on land sales to developers. At this stage, there is no evidence of another economically significant COVID-19 outbreak, and authorities have all of the tools that they need to stop the spread of distrust for the residential construction sector. While vigilant, we therefore continue to hold a positive view on China's outlook, with through-the-year growth to December 22 and 23 of around 5.5% our base case, leaving year average growth for the 2 years at 3.5% and 7% respectively. Against a stalled US and Europe and given global uncertainties, these are strong outcomes. We'll see you next time.